these cross currents are actually potentially very, very violent. And so you got to wear a tin hat and make sure you keep your head down, basically. I think that moment is approaching, actually, in the next 4, 5, 6 weeks. It can't be far away. It can't be far away.
You're watching Capital Calls, and my name is Danny. It is February 19th, 2026, and we've got Simon Hunt and Alasdair Macleod back on for another round of talks. Gentlemen, the people loved you guys last time, so we've got to do an encore. Thanks for coming on.
Nice to be here.
Well, they love us again this time.
Well, let's hope so.
Well, I'll let you continue
this time.
I'll let you continue your discussion that you were having off camera. You were talking about AI, and you see AI taking in a different turn than most. Simon, go ahead and lay out your thesis, and then Alasdair can respond accordingly.
Yeah, my thesis comes from two insiders that I managed to get hold of. I won't name them, but one was the director of a very well-known A1 company, and the other is a co-founder and CEO of an A1 company. The former resigned because he didn't like what was coming, and the latter spelt out in a 10-page report, which I found on X, going through blow by blow how A1 is going to cut into the employment in a wide range of industries. And he quoted the story of a senior partner in a legal firm who is using A1 and is seeing how his number of employees are going to be cut dramatically. And then when I went through all of the 10-page report and the one paragraph that I pulled out of the other guy's resignation letter, I then picked up a comment from another insider saying we're going to lose at least, this is in America, 20 million jobs over a number of years. I then actually went through the sector by sector job employment and then linked that into what these two guys are saying. And I came up with 40 million. And 40 million not over 10 years, but probably over 3 to 5. And the consequences are not just on a society, they're on government revenues. 83% of government revenues comes from taxing employees and taxing companies on their employment stuff. So that's 83%. And if you're going from an unemployment currently, supposedly, they're probably much higher, at 3% or whatever it is, up to probably 6% at the end of this year, and 8 to 10% next year, and God knows how much thereafter. That's going to be a big hole in government revenues. How are they going to match it? What are they going to fill it with? So it all comes back to the bond market, which is the Achilles heel of the American economy. The huge debt, it's not just government debt, it's debt of households, financials, and corporates. The total debt last year was 136 trillion compared to a GDP of 30.6. So the massive problems ahead. And I think that it's unlikely we are going to see 2026 as the start of the next bull market or whatever. That economic growth is going to accelerate. My sense is it's not going to happen. And that we're probably going to see a very disappointing year. Add that on to the geopolitical tensions, and it's going to be, at best, a very volatile environment for investors. Over to you, Alasdair.
Over to you, Alasdair. Just one quick comment on that note, Simon. I was looking at the World Uncertainty Index a couple of days ago, and it says we're sky high. And so it's questionable how one could measure uncertainty. But in an uncertain environment, clearly it's not conducive for investments. Investors do not like uncertainty. So I just wanted to add that in. Feel free to comment on anything else.
Good comment.
Yeah. Well, I mean, this is fascinating because if I look at it purely from an economic point of view, I mean, Simon's right, about the impact on debt. But I think only half right, because it's actually potentially a lot worse than you're saying. Now,
I left that for you to say.
well, we'll just throw a little bit of economic theory into this one. Many, many years ago, before John Maynard Keynes wrote his general theory, there was something called Say's law. Now, the basis of Say's law was that we produce things in order to buy other things. In other words, it is production that leads to consumption, not the other way around. Now, this is just really important. We now face a situation, which, as Simon describes, where we're no longer producing to consume. So if we're not going to be paid to produce, if you like, then how are we going to afford to consume? Who's going to fill up the balance? When it comes to all this wonderful capital investment in manufacturing things without anyone actually being involved in the manufacturing process, it all being done by robots and all the rest of it, how is it that there is going to be a market if the consumers have absolutely no pay and can't consume? In other words, it fractures the entire economic model of the diversification of labor. That's the fascinating thing. Now, we'll find out whether Keynes was right about dismissing Say's law or not. So this is fascinating, if you like, from that sort of rather arcane point of view. But what it does mean is that if consumers are actually going to consume these goods without being paid to produce them, then basically they're going to have to be paid by the government, because there's nobody else to step up and give consumers, if you like, the wherewithal to consume. And the only way in which government can do this, basically, because they will have lost, as Simon points out, they'll have lost the majority of their tax revenue. The only way they can do this is print like fury. So, right. The whole thing is just going to collapse. I can't see any other outcome.
President Trump actually alluded to this a few days ago. He said, "I have the match. I can cure unemployment at a whim. I can just hire everyone. I give everyone a government job, and that'll reduce the unemployment."
Good luck.
It won't be a government job. It'll be handouts. If you have unemployment at 10, 12, 20%,
sure, that's
a lot of money that the government is going to hand out. If you don't hand it out, you're going to have a civil war.
Well, yeah. And if you hand it out, you trash the currency.
Exactly.
You cannot win. You just cannot win. It's the end of the fiat currency system. And I think, as to Simon's point, most of us, I think, going into this year or going into last year in particular, probably thought this was going to take, we've got another 5 to 10 years sort of thing. But, this is fast track now. I mean, it really is.
Yes, absolutely.
And when people wake up they'll begin to realize why it is. I mean, it's interesting. I've got up, I don't know if you can get it up. You're very good with charts, Danny. The CRB index. I mean, it's tripled basically from the year 2020. It's tripled. Now, this is broad-based commodities. And when you get commodities rising like that, what it's telling you is the purchasing power of the currency which you're measuring it in for commodities as a whole is declining. Go back a bit further if you can. Yeah, you can see, there you go. Look at that. I mean, it's got a lot of that move. Basically, is the debasement of the currency. That's what it is. Because we haven't seen, we haven't seen a sort of wonderful renaissance in manufacturing or anything like that, except perhaps in China, where they manufacture a lot more efficiently than we ever did. And that's a process which is going to continue. I mean, it's now breaking out. It's a fascinating where you've drawn the lines. I think that's valid, actually. Off to the races. For everything. I mean, copper, which is Simon's speciality, I would have thought is in the van. And today we've got crude oil up at, WTI is up at $66. Recently it was, 55, 56? So
well, that's probably because of what's going on with Iran.
Well, yeah, I don't disagree with that. But if that was serious, I think it'd probably be quite a lot higher. So, but the point is that the purchasing power of the currency, in this case, the dollar, is declining at an accelerating rate. And this is going to be first reflected in commodities broadly. And gold is leading the van in this one. I mean, really. Then you've got the other problems. And I think, AI is a very, very interesting take on where we're going.
Absolutely.
Gold. Yeah, you mentioned gold, so my ears obviously perked up for that. What's your? It looks like, from a technical standpoint, it looks like gold's been coiling up. And did we break out here, Alasdair, Simon? What do you think?
I think. Yeah. Sorry, Simon, you go ahead.
I think that over the next couple of months, 2 to 3 months, we're going to have a big correction in global equity markets. I think that will spill over into gold, silver, and the base metals. At the moment, taking copper as an example, the market is in heavy surplus and will remain in surplus this year. It's the money game that has pulled copper prices up to $13,500. I think we are on the way down to 7,000 by the end of the third quarter of this year. And then we will start a real 2-year enormous bull market where we will see a final peak after a big correction in 2028. We will then see a top in the copper price of around, hold on to your hats, $28,000. But then if you convert that back into 2026 dollars, the price is $14,300, not too much different from today's price because of, as Alasdair says, debasement of fiat currencies, which leads us back to Alasdair's forte, gold. What is the price of gold going to be in 2030, let alone in 2028?
Yeah, well, I mean, the way I look at it is we are coming to the end of the fiat currency era. And if you look at the politics today in this respect are very, very similar to what they were in Germany between 1918 and 1923. And, the end result of that is that priced in dollars, gold goes to infinity. It's not gold going up, it's the dollar going down and becoming completely worthless.
Exactly.
So that's where we're going. I would agree there is always uncertainty over the short term. And, whether it breaks out now or whether it consolidates more, whether a collapse in the equity bubble, which, as far as I'm concerned, is absolutely certain, because equities are wildly overvalued relative to bonds. Bond yields will rise. When that begins to happen, I think when you see the 10-year US Treasury note going through 4.75%, heading up towards 5 and beyond, that's going to be the moment, if not slightly before, that the bull market in equities will be dead. And I think the slide from there will be extremely nasty. As far as gold and silver are concerned, I think that the mining shares are more exposed to this than perhaps gold and silver. The reason I say that is because investors don't hold gold and silver. They really don't. I mean, it was fascinating. You sent through a thing to me earlier, Simon, looking at, the sort of Hartnell's survey of investment expectations and how gold is a crowded trade. I mean, this is rubbish. It's complete nonsense. I mean, it's one thing to say, well, gold looks like it's going higher, but it's another thing to actually own it. And if you don't believe me, look at the ownership of GLD and SLV. I mean, they haven't really gone up much. If they've gone up, it's because of value of the units rather than people actually buying new units being created. So, I mean, this is not a crowded trade. I mean, ownership, if you look at global portfolios, over $300 trillion around the world. Of that, invested in gold is roughly half of 1%, just half of 1%. Is that a crowded trade? I don't think so. But what you could have, as to Simon's point, is that when you get a collapse in the equity market, I mean, basically, it's the excuse, if you like, to just get out of everything, irrespective of whether it's a good thing or not. And you can certainly see that someone, let us say, with profits on their mining shares, will use that as a source of funds to cover the losses on AI stocks, for example, going back to our subject. I mean, we saw that in the great financial crisis. And in the case of gold, yes, gold was a crowded trade then. Gold fell from $1,000 down to $680 over the course of the great financial crisis. It then subsequently went to $1,920. So that's, if it happens, it's a short-term effect. But I would argue that the degree to which gold ownership is embedded in portfolios is actually very, very minor. I think there could be an effect on the mining shares. But the other thing is, bear in mind that the pricing of gold and silver is no longer under our control. It's being controlled in China. That's where the market is, the physical market. And what we're seeing in derivatives at the moment is, I think you're seeing the beginning of the end of the derivative system, certainly as far as managing risk in commodities. That, I think, is on its way out. And that's starting with silver, because people are stuck in silver. They're short. We've got a delivery coming up. And I was looking at it this morning. It's something like 56,000 contracts standing for delivery, potentially. And I mean, that should wind down towards the 26th, 27th of this month, which is the first day. And on that basis, you would think, well, that shouldn't be a problem. But there's only about 19,000 contracts, if you like, of registered silver available for delivery. It's going to be a close-run thing. There could be a crisis in that. I think it gets avoided, because basically what happens is that if there isn't silver to deliver, then the shorts being forced to deliver will turn around and negotiate with the longs taking the silver and say, do you mind awfully if we pay you cash instead? And if so, how much do you want? So it'll be, I think that's the way in which this will actually happen. But you can see this is, we're seeing these cross currents are actually potentially very, very violent. And so you got to wear a tin hat and make sure you keep your head down, basically. I think that moment is approaching, actually, in the next 4, 5, 6 weeks. It can't be far away. It can't be far away. Yeah.
If this becomes a regular phenomenon where they just start settling in cash with the COMEX, does this not destroy? Are these not cracks in the wall of the COMEX over time? Like if this becomes a norm, so to speak,
well,
what does that spell for the COMEX?
Yeah, they've done that before. I mean, it's been a sort of fairly regular feature, actually. So we're not breaking new ground in this sense. But the big question is, with such a shortage of physical silver, do you take cash or do you say, no, I want the silver? And I think that's the big issue. In the past, it's been quite simple. You could bribe me as a long quite easily. Just give me enough cash and I'll go away. Thank you very much. But now the silver is so demanded that price is not really all that relevant anymore. It's, there's a shortage of silver and that's got to be dealt with. And if I've stood for delivery, I'm going to want the silver and I don't want the cash. I mean, that's the way it is. There may be a level for some people, who perhaps have been punting it. But if you look at open interest in both the silver contract and the gold contract, there is virtually no speculation in there. There are not people who will go and stand for delivery and say, right, okay, I'll take cash, and this is my starting bid or what. No, I mean, that's the people to do that. They're not there. That's not what the market is now. So it's going to be interesting. Very, very interesting.
Simon, I know your take on the precious metals is what it is, but do you also share Alasdair's sentiment there as it relates to gold?
Completely. I think any shakeout that we have lays the foundations for the next move up. Yeah. And if you, we've got the DXY at 51 in 28, 29, that tells you gold is going to be at least $10,000. At least.
Well, you also had this one guy take up a huge bet. This mysterious guy take up a huge bet on gold prices. He bought like 11,000 contracts of gold call options at $15,000. So that would effectively be a 3x in gold this year, is what he bet on. Have you guys seen this story?
No, I haven't seen it.
Nor me.
I think that's it doesn't sound right, actually. It really doesn't. I mean, unless what I could see is someone taking a position of that sort where they're short, trying to protect themselves from a real collapse, if you like, in the currency, or if you like, in market terms, a gold price which would otherwise just completely wipe them out. But that sort of capping, using options to cap, will be more like, sort of say $6,000, not 15. I mean, it doesn't make any sense to me at all.
Danny, did that guy punter come from China?
I don't know.
Good question.
That's a good question indeed. Yeah. Well.
Anyway,
it's moving on to other things, guys. You did mention the geopolitical tensions ongoing around the world. So, Simon, I want to ask you, with the Iran war potentially being a major catalyst, it could happen this weekend by the time this video comes out. So, which asset class besides physical bullion survives the first 90 days, or would this kind of elicit a spiral across all asset classes?
Let's see. Let's try to get to grips with what the negotiations are really are all about. Trump wants a deal on nuclear, and only on nuclear. And Iran has said the negotiations are only about the nuclear enrichment process. There is, I think, good grounds for saying that there could be an agreement on that. Trump walks away, victory, loud acclaim, good for the midterm elections. The problem is that not everybody in his camp would go along with that. And in particular, it is not what Bibi and Israel want, which is the complete dismantling of Iran's ballistic missile arsenal and the stopping of support for Hamas, Hezbollah, Houthis, etc. So the question is Trump strong enough within his own government to go for a negotiated settlement on uranium enrichment? That's the big question. If he's not, then I think there will be war, and that will probably be in the early days of March. And the consequences of that will be phenomenal, not only oil prices, but global economic activity, and regionally too, as I sit here in Dubai.
You had Professor Marandi, who was an Iranian professor over there in Tehran, and clearly has some connections on the inside. And he basically sent out a tweet yesterday saying to evacuate. It'd be wise to evacuate the Gulf states. You being in Dubai, Simon, how will the Gulf states be intertwined in all this?
Well, Iran has already said that if we are struck, not only do we hit Israel immediately and the vessels in the Oman and Arabian seas, but we will hit all the American bases in the Gulf. I think that given the back channels and given the relationship historic between the UAE and Iran, that the strike will be a hypersonic missile on the American airbase south of Abu Dhabi. And that's it. There's too much Iranian money in Dubai. There's a long historic association, trade association. There's a very big Iranian school, and I believe 2 Iranian hospitals, and with a large Iranian population. And I think that'll be the same for the other Gulf states. But all the bases will be hit. Now, the problem that faces Trump is, who does he listen to? Is he listening to what the Pentagon is saying, which is don't attack? Or is he listening to the hawks in the cabinet and his big donors, all of whom want Iran to be eradicated? So it's a 50-50 in my view.
Alasdair, I want to take it to you as well. Here's an article from the Times, just came out today, actually, and it says the UK is blocking Trump from using its RAF bases for strikes on Iran. So disagreement over the use of the British sites behind U.S. President Trump's withdrawal of support for the Chagos Island deal. This is from the Times.
Yeah. Well, the problem we have, I think, with if you like, the mainstream media here is that they are the mouthpieces for MI6 in this case. Usually MI5 as well, but MI5 is domestic intelligence. So it's interesting. I think that's more interesting in the light of the problem that the British government has in terms of ceding the Chagos Islands to Mauritius. That I think is becoming, I think a real issue again. Trump has flip-flopped on this a bit. So I think that's a slightly different story from the one we're talking about. I think what I'd like to add to what Simon was saying is that my understanding is that the Iranians have also said that they would attack Israel if America attacked them. Now, my understanding is that Israel actually doesn't want to get involved because their Iron Dome and all the rest of it has been proved to be not up to scratch. And not only that, but Iran has now been supplied, as again I understand it, with restocked with more modern missiles, hypersonic and all the rest of it, so that their, if you like, punch is far, far stronger now than it was, when Trump went in and tried to take out the nuclear processing side. So this, I think, is actually slightly more complicated than it first appears. It could be that what happens is that Trump takes the view that his donors and those which are Israeli, if you like, in origin, the Jewish faction, if you like, the Jewish pressure group, are probably not going to, if you like, they would like to see Iran gone, but they will realize that this is unrealistic because the consequences for Israel would actually be very, very damaging. So I think, and you see, the other thing is that, the Pentagon, I think, would be absolutely right in turning around to say, look, don't do this. It's not just the oil price question, but Iran is an enormous country. It's several times the size of Iraq or Syria or whatever. This is not something which you can sort of take on militarily without the thing being incredibly expensive and incredibly demanding in terms of military resources, which, frankly, the Americans have not got. Basically, their ammunition stocks are down because they've been supplying it to the Ukrainians. So, I just can't see how they can they can have a war on this. The only thing I'm sure that Trump will have explored is, well, is there something we can do quickly, like we did with Maduro in Venezuela, and that's the end of it. The answer is no. So Simon reckons 50-50. I reckon that it's unlikely that this will go ahead. But I think the point is that Trump does need an exit from this. And that's what the Iranians will be working to give him, because they realize that Trump's real problem is the midterm elections. And
I agree.
His popularity is sinking rapidly as it is in domestic America. He's got to do something to try and claw that back. So I think that's the way it would probably work. But whether some sort of agreement with Iran will be enough, if you like, for him to be able to realistically say, there you are, part of the deal, I've managed it again, and I'm the only person who can do these things. Well, we'll see.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. the same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video.
I think if there's no strike this time, it's only a postponement. And that a real strike will come 2027 or 2028.
I think the other thing, and I'd be interested in your view on this one, Simon, is China's role in this, because I just get the feeling that China is more on the front foot than it has been for a long time, or almost ever, if you like, since Mao Zedong died. I mean, they are now actually proactively attacking America financially, like telling their licensed institutions holding US treasuries, sell the damn things, get out, saying it's volatile and all that. Come on, there's been no volatility in the treasuries for the last 6 months. It hasn't been volatile. That's an excuse. I just think that when push comes to shove over Iran, I think you'll find that it's not just Iran you're fighting, but you're fighting Iran supported by China, and a lot more visibly than in the past.
What has recently been signed, only a few days ago, is a tripartite strategic alliance between Russia, China, and Iran, which basically says, if Iran is struck, we will be behind you. Yeah. They have supplied, Russia has supplied their latest missile technology. China has supplied their latest radar satellite intelligence.
And has shipping. With intelligence shipping in the area too.
Yeah, absolutely. Yeah, they have this surveillance vessel, which has this up-to-date radar systems, so they are able to track all the American submarines. And they've also got supporting vessels, 2 of their most up-to-date destroyers. So Trump hits Iran. He's hitting Russia and China at the same time, which leads me to my 50-50 call of an imminent strike. And if there is a strike, which is likely, it will be postponed for a year or 2.
Yeah. Yeah, it continues to fester if nothing is done. I think that's one of the problems that the Americans face. We'll see. But I think the midterm elections are really sort of setting the timing of all these things.
But they have moved a lot of personnel and equipment into the Gulf of Oman, into the Gulf of Persia there, and in the Mediterranean, not in the Gulf of Persia, but in the Gulf of Oman and in the Mediterranean Sea. Is that, I mean, can they really just put all these things in place and just turn around and go home? I mean, that would require, I mean, he would lose a lot of face in the process.
Whichever, he's stuck. Whatever he does, it's going to turn out badly.
I think if I was him, I would say to the Iranians, for God's sake, get me out of this shit. So we'll see. Yeah. But on the other, so that's
the other hotspot, of course, continues to be Ukraine. And I think that the negotiations that have been going on in Geneva and elsewhere are going to go nowhere. And that Ukraine will be decided on the battlefield, not through diplomacy, and only when Russia has got what she wants, which will include Kharkov, Odessa, and even Kiev.
Yeah, I think that's absolutely right. And I mean, the ridiculous thing in this is the way the Europeans are behaving. I mean, it's just stupid beyond belief. I mean, we're seeing, I think, the most extreme example of political groupthink you could possibly imagine going on in Europe. It's just unreal.
But they've got so many and huge problems domestically, from debt, from the bureaucracy in Brussels that the electorates hate now, that they're looking for, as always, an external factor, which is war.
Yeah. Well, it's just complete craziness. And the other thing, I mean, talking about debt, of course, they're up to their necks in loans and funds going into Ukraine, which are worthless, completely worthless, and nobody can afford to write it off. You know, it's just.
I mean, the other thing is there's a lot of chatter and hope in America that the war ends and that American companies and EU companies will gain massively from the reconstruction of the Ukraine. My take is Russia is not going to allow that. They're not going to allow American and European companies running around their own territory. The reconstruction will go to Russian and BRICS member partner companies.
And particularly China.
What that means is, I can't remember the figure, but there's a lot of money that the big US institutions have invested in Ukraine, either directly or indirectly by owning the mortgages on the land. So that'll be another big hole in America's debt.
Yeah, BlackRock and all the rest of it. It's, I mean, I don't know why they bought into it. I mean, it's just crazy, absolutely crazy. I mean, you're right. It's getting to the stage where, we can see the bit that Russia actually wants. But the other thing she wants is she wants NATO out of the rest of Ukraine. And not only that, but the rest of Ukraine not joining the European Union. European Union is trying to, von der Leyen is trying to get some sort of fast track mechanism in, if you like, to shortcut this. But basically, I think what it means is that Russia will take over virtually the whole of the Ukraine and keep the bit it wants and then impose conditions on the bit that it doesn't want.
Correct.
Well, gents, I want to take it back to the macro side of things. This is a chart from the St. Louis Fed, and it's looking at the overnight repo purchases over the last year or so. Now you see all these spikes here occurring. The latest one was on Tuesday, a couple of nights ago, $18.5 billion in repo purchases. Now, as you can see here, we've had a number of instances where we've had these repo purchases in the past, but they always occur right before big events. The last time we had a huge amount of these repo purchases overnight repos was right before COVID here in 2020. Before that, you had them spike up here before the 2008 crash. And then you also had some here during 2000, just after the 2000s, just right around 9/11, actually, interestingly enough. But what do you make of these recent surges in overnight repos from the Federal Reserve?
Well, it's an indication. Sorry, do you want to go? Okay, it's an indication, if you like, of strains within the banking system as a whole. What we don't know is whether it's one banking system or several banks. Sorry, one bank or several banks involved. Bit difficult to really work it out. I mean, there was the spike in the rate some time ago. I think we're going back to September 2019. Actually occurred when Deutsche Bank was selling its prime brokerage, I think, to BNP, and I think quite a lot of the customers of the prime brokerage, if you like, moved funds away. So that had to be replenished somehow, and that, I think, was led to the spike in the rate. Then what happened was that the Fed came in and basically just provided what was necessary in order to keep the repo rate within the Fed funds rate target. That's the whole thing. And I suspect that this current spike is probably to do with trying to keep the rate within the Fed funds rate spread. So without the Fed doing that, you would see the repo rate rising very, very sharply. I think it's a bit too early to say there's a real problem, if you like, in the banking system, because, as I say, we don't know whether this is just one bank or whether it's several. And I think also 20 billion nowadays doesn't buy nearly as much as it did, let us say, even 10 years ago or even 5 years ago. So I think that's something we watch with interest rather than, let's say, extrapolate too much at this rate at this time.
Yeah, Simon, your take as well. 18.5 billion dumped overnight into the banking system. What do you make of that?
I think Alasdair is absolutely right. I think the other comment that I would make is that the Treasury is desperate to get 10-year treasuries down from the current 4+% range, because they've got something like $10 trillion of refinancing to do. And whether you refinance at 4, 5, or 2 to 3 is a huge, huge difference. And at a time when your foreigners are not going to be coming in.
Indeed.
Good point.
It's a mess.
Yeah,
it's a huge mess.
You're right. I mean, the other thing you could say is that this wouldn't happen if rates were a little bit higher. Possibly.
Yeah.
Because, is this an indication that actually the idea that rates are going to fall further are premature? I think that's quite likely.
Yeah.
But as I say, I think this is something we just watch with interest at this stage. I mean, they're going to have to print hugely. I mean, they really are. And that's even without the stock market collapsing. When the stock market collapses, then my goodness, I mean, you'll see QE take off to unimaginable quantities. Because apart from anything else, stocks are collateral for the banking system. It's got to be supported.
And it seems like they've bet the entire house on AI being the productive utility to essentially be productive enough to create enough GDP to push us over the line and escape the debt spiral. But here's an interesting clip I want to show you guys. I just found this from the All In podcast, and they're actually not as optimistic about AI for some interesting reasons. So let's go ahead and tune in here. Let me know if you guys can hear it.
You can clearly, we with our agents hit $300 a day per agent using the Claude API, like instantly. And that was like doing maybe 10 or 20%. That's $100,000 a year per agent.
we're getting to a place where we have to basically now say, what is the token budget that we're willing to give our best devs? And then if you aggregate it across all people, you can clearly see a trend where you're like, well, hold on a second. Now they need to be at least 2x as productive as another employee. That is actively happening inside my business because otherwise I'll run out of money.
Yeah, this is a very interesting trend that you're not going to hear anybody else talk about. But when do tokens outpace the salary of the employee? Because you're about to hit it. I'm about to hit it.
So there you go.
Yeah.
So the cost of running AI is coming to the point where it's actually more efficient to just hire a normal human being as opposed to an AI agent to run the task.
Comes back to how we started this chat.
It does a bit, and I think I'm sorry, I don't sort of go with it. Don't forget that the Chinese have actually managed to crack this on something like a $5 million budget.
Yes. Yes.
And everybody dismisses it. Oh, it's pretense, or they're copying everybody else and not doing original stuff. But come on, it's absolutely. I mean, the Chinese will take over the whole of the AI thing, simply because we're so inefficient at it. I mean, chucking, tens of billions of dollars on each project. I mean, it's just nonsense, absolute nonsense. The Chinese can do this, standing on their heads. So, and they're already doing it. Look at their robots and all the rest of it. I mean,
anybody who's got any doubt should see those videos of the robot soldiers firing guns and the kung fu dance. Unbelievable. But and being practical.
Compare it with last year. No, they're absolutely fearless. I mean, I think the way this is going is that AI is now creating robots. They will manufacture the robots. They will give them their intelligence, and then robots will beget robots and all the rest of it. And then they'll decide we don't need these bloody humans anymore. So time I think for a nuclear conflagration.
That is why the director from Anthropic has resigned, because he's scared as to what he has helped develop. And what is he going to do? He's going to the UK to learn how to write poetry at university.
Well, I look forward to his first book of poems. But I mean, actually, the main point you're making, Simon, is this is an expert. We're not experts in this. This is an expert who is terrified about what is created.
Yeah. I mean, the actual words he used in his resignation letter is, the world is in peril.
Yeah. Yes. Oh dear. Well,
on that note,
you brought us around full circles, Danny.
There we go. I'm trying to find the letter of the Anthropic CEO, but well, if I'll find it, I'll post it in the description box down below so people can read it themselves. Well, gents, thank you so much for coming on. It's always a pleasure having you both on at the same time. Anything else you guys would like to talk about before we wrap up?
Well, my mantra is get out of credit, get into real money. I don't care whether it goes up, down, sideways, or whatever in the short term. Credit's going down to zero. And perhaps the robots will push it there as well. So it's quite simple. MacleodFinance.com. You'll find all you need to learn about the difference between money and credit there.
And Simon,
from my point of view, what you should be owning would be gold, art, and food.
Food actually is going to be well. I mean, it's vital, obviously. But
food prices are going to soar.
Absolutely.
Well, we short of food.
Yeah. In this country, we're busy covering the land in concrete houses, or trying to, and solar panels. And, to hell with the farmers. It's very short-sighted. I think. I mean,
and very yeah.
This year, my garden's going to be turned into a vegetable patch, I think.
For the people that don't have gardens, though, how should they stockpile food, in your view?
Well, buy a freezer, good freezer. Then you've got to rely on the electricity system. But basically, freezers, they cut it off for 5-6 hours. Freezer's okay, but that's one way. And the other thing is just grow it.
No, the other things, talking about electricity, you have your own self-generator.
Yeah.
Those units are available and not expensive.
No, exactly.
Particularly if you get them from China.
Yes. Indeed. Yeah.
Well, all right. Simon, where can people find you?
Simon at shss.com or else simon-hunt.com.
Excellent. We'll have the link to your website down below, Simon. Alasdair will have the link to your Substack down below as well. So be sure to check out both website and Substack, everyone. Guys, thank you so much for watching. If you got value out of this content, hit that like and subscribe, and also hype the video. It's a new feature on YouTube. I believe it only pops up on your phone, however. You've got to like the video, and then it asks you if you want to hype the video right underneath it. You want to hit that button. I'd really appreciate it if you do. And subscribe to the channel so you don't miss an episode. And check me out on Substack at capitalcosm.substack.com. Get access to all my stuff early, ad-free, and uncensored. And I will be replying to the comments here. So drop me your comments. Can't get to all of them, but I will make it a point to reply to a good chunk of them. So drop your comments down below, and I will catch you all next time. Bye.